I'll start signing the executive orders. To me, this is a very, very big deal. One of the executive orders has to do with cashless bail.
Tariffs.
He's removing his tariffs, yeah.
Exactly.
He's removing his retaliatory tariffs, which I thought was nice. And we're going to have another call soon. Yeah, we had a very good call.
You're getting closer and towards the
Well, I like
film
him.
trade?
I like him. You know, look, I'm fighting for the United States. Canada and Mexico take a lot of our business over the years, over 25, 30 years.
Imagine waking up one morning, scrolling your phone, and realizing the rules of the economy have changed overnight. Not in Beijing, not in Brussels, but right across the world's longest border, Canada, the country that America always thought of as its closest, safest trading partner. Just flip the chessboard, and 7 American giants are already watching their foundations crack. A tariff here, a tariff there. For years, tariffs were political headlines, something you skim past while drinking coffee. But now, they're bleeding into family budgets, job security, and the survival of industries. Empty malls, silent factories, boardrooms in panic, charts sliding downward like falling knives. This isn't economic theory. It's the story of what happens when America's most reliable neighbor stops playing by Washington's script. Picture Ottawa, deep in winter, frost on the windows, trade ministers from 11 nations locking hands in historic deals. Australia, Japan, South Korea, the UK, Brazil, India, Norway, Switzerland, Vietnam, Singapore, New Zealand. Every handshake closing a circle, every deal cutting America out. And here's the stinger. While American officials sat in a waiting room down the hall, uninvited. This wasn't ceremony, it was strategy, a new economic web spun right under America's nose. Let's put it in perspective. The US and Canada move $780 billion of goods and services every year. That's more than America trades with China, more than Mexico, more than the entire European Union combined. It's the single most important bilateral trade relationship on the planet, and yet, Canada just gave preferential treatment to 11 other partners. Nations that produce the exact goods that American companies once dominated. Electronics from South Korea, cars and parts from Japan, food from Australia, pharmaceuticals from Switzerland, energy partnerships with Brazil, every deal chiseling away at America's comfortable monopoly. If you're asking, so what? Won't American brands survive? You're missing the point. Because this isn't just about market share, it's about infrastructure, about 20,000 American jobs tied to supply chains that may now collapse, and the dominoes are already falling. Walk with me through a massive distribution hub along the US-Canada border, miles of conveyor belts, thousands of trucks waiting in line, a billion-dollar artery pumping goods northward. One retail giant, let's call it Retail Titan X, staked its future on Canadian consumers. 47 distribution centers, 18,000 workers, $847 million in Canadian revenue every year. But here's the nightmare. Canada's new trade partners don't need American middlemen anymore. A Japanese cookware company can ship directly to Toronto. A South Korean electronics brand can bypass US warehouses entirely. Australian meat and wine, straight to Canadian shelves. No American ports, no tariffs. The foundation of Titan X's empire, gone overnight. Internal leaks already show projections of a 23% revenue collapse in Canada, emergency plans for mass layoffs, consolidation of warehouses, analysts calling it a fundamental restructuring of North American retail dynamics. And Wall Street noticed. The company's stock plunged 8% in a single day after Canada's deal went public. But the deeper wound isn't numbers, it's logistics. You can't just rip apart 47 distribution centers and retrain thousands of employees to serve markets you never prepared for. It's like rewiring an entire power grid while the lights are still on. Now, let's shift to Detroit, the city that once roared with the sound of assembly lines. That roar is now turning into a cough. One American auto parts manufacturer, we'll call it AutoCore Systems, built its fortune on Canadian integration. Their precision-engineered components power vehicles across North America. $1.2 billion in Canadian sales annually. Factories in Michigan feed plants in Ontario. Parts cross the border daily in a dance of just-in-time delivery. But Canada's new deals, they've opened the floodgates. South Korea and Japan, two nations that not only produce parts of equal quality but often at lower cost, now have preferential tariff advantages. Here's what that looks like on paper. Brake systems from South Korea land in Canada with a 15% cost edge over American imports. Engine components from Japan skip red tape while American suppliers drown in paperwork. The result? Canadian car manufacturers are already taking calls from Korean suppliers. Japanese executives are touring Ontario factories, measuring production space, negotiating joint ventures. What once was America's crown jewel, an integrated North American auto industry, could fracture in months. And remember, this isn't just about companies losing orders. It's about Detroit losing its heartbeat. Every supplier chain that unravels takes with it thousands of jobs, decades of expertise, and the pride of a city that already knows what collapse feels like. This isn't random. Canada didn't just roll the dice. Every new partnership was surgical, each one aimed at a sector where America assumed dominance. And now, for the first time in modern history, America's northern neighbor has leverage to squeeze. We're looking at a quiet revolution, not with tanks, not with troops, but with trade routes, tariffs, and backroom agreements. So far, two industries are on the chopping block, retail and auto parts. But this is just the beginning, because when we zoom out, 5 more American giants are standing on the fault line. From agriculture to pharmaceuticals, energy to finance, the earthquake is spreading. And the real question isn't if America will feel it. It's how hard, how soon, and who gets crushed first. The agenda was short, just one item on the table: strategic response to Canadian market disruption. Behind those closed doors, America's largest corporations weren't debating quarterly earnings. They were fighting for survival. Analysts call it an existential crisis disguised as a trade dispute. And the next domino? The bedrock of America itself, agriculture. Amber waves of grain stretching endlessly across the Midwest. Combines cutting through golden wheat under skies so wide they swallow the horizon. Grain elevators rising above small towns like steel cathedrals. This isn't just imagery. It's the lifeline of America's heartland. For decades, one agricultural titan, Agricor International, dominated this flow north. $2.3 billion in annual exports to Canada. Wheat, corn, soybeans, processed foods. Nearly a third of that trade carried by Agricor's own grain terminals and processing facilities. Canadian families depended on these shipments, but Canada's new trade deals flipped the script. Australia and Brazil, two agricultural powerhouses, now enjoy preferential access. The math is brutal. Australian wheat enters Canada with a 12% price advantage. Brazilian soybeans bypass red tape, processed in days instead of weeks. Processed foods that once needed American facilities now ship directly from overseas suppliers. What does that mean on the ground? The river of American grain that once flowed steadily north is now drying to a trickle. And here's the nightmare. Agricor's infrastructure is built on volume. Grain elevators only stay profitable if they're constantly filled. Processing plants only run efficiently if the pipeline never slows. When Canadian demand drops, the whole machine collapses backward into America. Farmers in North Dakota, Montana, Minnesota, where up to 60% of export revenue relies on Canadian buyers, are already watching commodity prices nosedive. Small towns built around processing plants are facing the unthinkable: layoffs, plant closures, and the hollowing out of local economies. Buried in Agricor's latest quarterly report was a single chilling phrase: facility consolidation and workforce optimization across northern operations. Translation: closures, layoffs, the slow strangulation of rural America. Industry insiders are calling it a new dust bowl, not caused by drought, but by diplomatic drought. Shift from the fields to the oil fields. Pump jacks silhouetted against the setting sun. Refineries that look like cities of steel. Pipelines stretching across states. Arteries carrying liquid power. For decades, American leaders preached energy independence. But one corporation, North Energy Corp., quietly built its empire on the opposite idea: energy interdependence with Canada. $3.4 billion annual revenue from Canadian operations. Pipelines moving Canadian crude to U.S. refineries. Processing facilities turning Canadian gas into American heat and electricity. It seemed bulletproof. Canada had the resources. America had the refining power. A perfect marriage. Until now. Canada's new partners include Norway and the United Kingdom. Two energy heavyweights bringing advanced technologies and distribution networks. But the real disruptor? Australia. Unlike American firms that treated Canada as a resource colony, Australian energy companies are offering partnerships instead of dependency. They're funding joint ventures that keep refining and processing in Canada, while opening pathways to Asian energy markets. The fallout for North Energy is catastrophic. Canadian crude shipments south are projected to drop 34% in 18 months. Refinery utilization will fall to 67% capacity, well below profitability. Pipeline revenues are already bleeding, forcing emergency restructuring. And the second wave? Pricing collapse. North Energy's business model depended on stable Canadian supply. Without it, their refineries can't compete globally. The market reacted instantly. Stock down 15% since Canada's announcements. The CEO issued a statement dripping with forced optimism. We remain confident in long-term partnerships with all North American allies. But insiders weren't fooled. They read it for what it was. Desperation disguised as diplomacy. Now, from fields and oil, let's step into Silicon Valley. Glass towers gleaming under the California sun. Server farms glowing with millions of blinking lights. Fiber optic cables pulsing with the data of modern civilization. For 20 years, one tech behemoth, Datalink Systems, ruled North America's digital arteries. Their Canadian operations were the backbone of continental connectivity. 847 million daily transactions routed through Canadian servers. 12 massive data centers. 8,000 employees safeguarding banking, healthcare, and even government systems. $1.8 billion annual revenue from Canadian contracts. It seemed permanent, untouchable. But Canada's new agreements with Switzerland, the UK, and Singapore, nations known for data security and advanced digital infrastructure, are reprogramming the future. Switzerland brings banking-grade encryption. The UK offers cutting-edge cloud technologies. Singapore provides lightning-fast fiber routes to Asia. Why would Canadian industries keep relying on an American gatekeeper when they can now plug directly into world-class systems at lower cost and with fewer geopolitical risks? Already whispers ripple through the sector. Canadian banks testing Swiss-based data solutions. Healthcare systems trialing UK-hosted secure cloud records. Universities exploring Singaporean research data hubs. For Datalink, the nightmare is scale. Their entire empire was built on the assumption that data, like water, would always flow through the most efficient pipe. For decades, that pipe was American-managed infrastructure in Canada. Now, Canada is laying new pipes, and they don't connect back to Silicon Valley. So what happens when 847 million daily transactions start rerouting through someone else's servers? You don't just lose revenue, you lose trust, you lose dominance. And in tech, once trust is gone, it's gone forever. Every empire falls the same way. Slow cracks at first, then sudden collapse. For America's tech, manufacturing, and finance giants, those cracks are widening. Canada's new partnerships aren't just trade deals, they're exit routes, building entirely new systems that bypass American dominance. And now, the fallout is spreading faster than anyone predicted. For decades, the digital bloodstream of North America flowed south. Canadian data passed through American servers, routed through American cables, processed in American hubs. That proximity was America's secret weapon, a geographic chokehold on information. But Canada's new agreements have ripped open new highways. Singapore and South Korea offer cutting-edge processing with ultra-low latency to Asian markets. Switzerland brings bank-grade security trusted worldwide. The United Kingdom supplies AI frameworks that plug seamlessly into Canada's innovation ecosystem. And then came the revelation: new trans-Pacific data cables. Built by Canadian-backed consortia, they bypass American networks entirely. Canadian data that once had no choice but to flow through Silicon Valley can now beam directly to Tokyo, London, Zurich, Sydney. The one advantage American firms counted on, geographic proximity, is dissolving in a world where data travels at light speed, where physical distance means nothing. Leaked internal memos from data link systems admit the scope of the threat. Canadian data sovereignty programs reducing dependency on U.S. infrastructure. Alternative routing protocols decreasing U.S. network utilization by 28%. Revenue impact assessments ongoing. But here's the deeper crisis. Datalink's entire North American strategy was built on one assumption: Canada had to use American networks to reach the world. Hiring strategies, research deals, billions in infrastructure, all on that single premise. Now, Canadian universities are signing AI research partnerships directly with Japan. Banks are linking financial pipelines straight into Swiss networks. Government agencies are testing data storage that explicitly excludes American intermediaries. Tech analysts call it the Great Decoupling, a rewiring of North America's digital map. And the markets see it too. Datalink's stock now swings 5 to 7% every single day as investors panic. Question for viewers: how do you rebuild a digital empire when the map itself changes overnight? Shift the lens to America's industrial backbone. Smokestacks, steel, the steady rhythm of conveyor belts. Australia is selling mining equipment that rivals Ameriforge's best. Japan is flooding the market with precision tools. Ameriforge didn't just sell into Canada, they built interdependent networks. Canadian plants made specialized parts for U.S. factories. U.S. factories made components critical to Canadian lines. The system was seamless, until now. German engineering firms, working through Swiss partnerships, are offering Canadian facilities the holy grail: independence from American suppliers. Japanese firms are proposing joint ventures to move final assembly to Canada, closer to new Pacific trade routes. Leaked strategy documents reveal Ameriforge executives scrambling, integration reviews underway, supply chain redundancy plans accelerated, workforce transition models prepared. Translation: American jobs on the chopping block, and the dominoes don't stop with Ameriforge. When one link in a supply chain breaks, the stress ripples outward. Small suppliers with Canada-only contracts face extinction. Workers trained for Canada-specific production are left stranded. Entire towns built around Ameriforge facilities now watch their largest employer reconsider whether staying open even makes sense. Industry analysts aren't mincing words. The unraveling of industrial North America. How many jobs vanish when supply chains rewire themselves around new alliances? Nobody knows, but the clock is ticking. Glass towers scraping the sky, trading floors buzzing, vaults holding billions in wealth. One Wall Street behemoth, Capital Access Global, believed finance was the one sector immune to geography. After all, money needs banks. Banks need networks. And Capital Access controlled those networks. Their Canadian operations generated $4.1 billion a year. Investment management, corporate financing, currency exchange, derivatives fueling international trade. Their client list was a who's who of Canadian power: energy giants, miners, tech firms, agricultural exporters, all relying on American financial networks to access capital. But that need is vanishing like frost in sunlight. Canada now has direct access to Switzerland's legendary banking systems, Singapore's Asian financial hubs, the UK's newly aggressive post-Brexit banking sector hungry for deals. And here's the twist. The UK, once America's closest financial ally, is now competing head-on with Wall Street. London bankers are swooping into Toronto and Vancouver, offering Canadian corporations cheaper rates, more flexible structures, and fewer strings than their American counterparts. The result? A financial exodus in slow motion. Canadian companies that once funneled billions through New York are exploring Swiss and Singaporean channels, some already signing MOUs with London firms. Capital access isn't just losing revenue, they're losing relevance. And in finance, relevance is survival. From data highways to assembly lines, from factory floors to financial vaults, the pattern is unmistakable. Canada isn't just diversifying trade, it's decoupling from America. Every new partnership is a scalpel cutting through an artery that once tied the two nations together. And with each cut, 7 American giants inch closer to collapse. But the story isn't finished. Because the final chapters, pharmaceuticals, consumer goods, even defense contracts, will decide not just corporate futures, but the balance of global power itself. The question isn't if America's dominance is breaking. It's, when the dust settles, will the United States still be the center of North America's economy, or just another player at the table? Canadian mining companies can now access London metal exchanges without American banking intermediaries. Energy corporations are trading in Asian markets through Singapore partnerships that provide more favorable terms than anything American financial networks can offer. For the U.S. financial giant, the mathematics are brutal. Canadian corporate clients represent 23% of their international revenue. Losing that client base doesn't just cut income, it dismantles the economies of scale that keep their entire global operation competitive. Internal risk assessments paint a stark picture. Canadian client retention rates are in visible decline as new financial networks offer advantages in cost, speed, and flexibility. Currency exchange volumes are down 19% quarter-over-quarter. Institutional clients are placing investment management assets under review. The dominoes are falling faster than Wall Street models can update. This collapse stems from a dangerous assumption that Canadian businesses would always need American banks as gateways to global markets. Entire strategies, staffing, technology investments, compliance structures were optimized for that dependency. Now that assumption has shattered. Canadian pension funds are forging direct partnerships with Australian superannuation funds. Insurance companies are testing European risk management systems. Investment firms are embedding themselves in Asian capital networks that cut American intermediaries out of the picture entirely.